Hello everyone, my name is Pratik and today I'm going to share some insights from my analysis of the Ames, Iowa housing market. Over the past few months, I analyzed 2,930 home sales from 2006 to 2010, a period that captured the housing bubble peak, the financial crisis, and the early recovery. My goal here was simple to figure out what actually drives home values and when buyers and sellers should make their moves. So, whether you're thinking about selling your home, looking to buy, investing in real estate, or developing new properties, this analysis has actionable insights that can help you make better decisions. So, let's dive in. So, here's the story. Why did I do this project? So, the problem real estate investors face is uncertainty. When you are buying or selling a home, you are dealing with hundreds of thousands of dollars. You want to know what features actually add value. Is it worth renovating? When should I list? Should I wait out a downturn? And my approach was straightforward. I took this rich dataset from Ames, Iowa, 2,930 homes sold over 5 years, and I analyzed it using statistical techniques. I looked at distributions, ran hypothesis tests, built regression models, and examined time series patterns. And the outcome, I can now tell you with confidence, quality is king, timing matters, and there's sweet spot for investors that most people miss. Let's look at what I found. So here are some key findings, and like these are some four big takeaways from my analysis and the numbers you need to remember. So first, plus $32,000. That's how much each quality points add to your home's value on average. I'm talking about the overall quality rating on a 1 to 10 scale. It's the strongest predictor in the entire data set with a correlation of 0.80. So, what does this mean practically? If you upgrade from average quality materials to good quality, you are looking at a $64,000 increase. Move from good to excellent, another 64,000. Quality is everything. Then second, $20,000 seasonal swing. So homes listed in June sell for about $20,000 more than the homes listed in January on average. And that's a 12% premium just for timing your listing right. This isn't a fluke, it's a consistent pattern across all 5 years in the data. Then third, minus $650 per year. That's how much homes depreciate for each year of age. A 30-year home loses, I guess, about $20,000 in value compared to a new one. And even if it's been renovated, that's the take here. So buyers discount age heavily and cosmetic upgrades don't fully overcome it. And then fourth, 22% decline during crisis. The 2008 financial crisis hit Ames hard. Prices dropped from $185,000 average in 2007 to $140,000 in 2009. But here's the interesting part. Recovery began in late 2009. If you had bought at that drop, you would have gotten a 20 to 30% discount compared to peak price. Like these four findings from the backbone of all my recommendations. And moving to next slide, let me give you some context about where these insights come from. So the dataset covers, as I told you earlier, 2,930 homes sold in Ames, Iowa between 2006 and 2010. And why this time period? Because it's perfect. We see housing bubble peak in 2007, the crash in 2008-9, and the early recovery starting in late 2009. This complete market cycle tells us how homes hold up value in both good times and bad. And the data includes 82 variables for each home, which includes things like square footage, quality rating, age, number of bedrooms, garage size, lot size, neighborhood, and many more. It's incredibly detailed. And my audience for this analysis is the Ames Real Estate Investment Group, which includes four types of people: sellers, who want to know when to list and what improvements actually add value, buyers who want to know when to shop and what features justify premium prices, investors who want to maximize their ROI, and developers who need to know what to build. So each group gets specific data backed recommendations by the end of this presentation. Then finding one, quality is king. So let's dig deeper into this. I ran correlation analysis on all 82 variables, and overall quality came out on top with a correlation of 0.80. That means the quality, like as quality goes up, price goes up in a strong, predictable way. Look at this table, an average quality home. So that's a 5 on 1 to 10 scale, which sells for about $130,000. Move up to good quality, a 7, and you are at 194,000. That's plus 64,000 or a 49% increase. So go all the way to excellent quality, a 9, and you are at $258,000. That's nearly double the price of an average quality home. Now here's the key insight. When I say quality, I'm talking about the materials and finishes used throughout the home. Hardwood versus laminate floors, granite versus formica countertops, crown molding, high quality fixtures, premium siding. These things matter most than square footage. So the takeaway here is if you are a seller thinking about improvements, focus on quality upgrades, not room additions. And if you are a buyer, pay attention to the quality of materials, and that's where the value is. So if you are an investor, target homes where you can cost effectively bump up the quality rating because that's your highest ROI move. Moving to the next slide, timing matters. So the second big finding is about timing. When you buy or sell matters a lot. So first there's a seasonal pattern. Homes listed in June, the peak selling month, average about $175,000, and homes listed in January average 155,000. So that's a $20,000 difference or about 12%. Why does this happen? So spring and summer are when buyers are actively looking. Families want to move before the school year starts. Homes show better in nice weather, and there's more competition among buyers, which drives the prices up. Now, let's talk about the crisis. In 2007, before the crash, the average sale price was 185,000. By 2009, at the bottom, it had dropped to 144,000. That's a 22% decline. But here's what's interesting. Recovery began in late 2009. Prices started climbing back up. If you had bought at that trough when everyone was scared and sellers were desperate, you would have gotten a massive discount and captured the recovery on the way up. And the takeaway here for the sellers is list in May or June for a $15,000 premium. Avoid winter listing if you can. And for buyers, shop in January or February. You can save, I guess, $12,000 just by timing your search. And if there's another market downturn, don't panic. It's a buying opportunity. And for investors, buy the dip prices through offer uh, 20 to 30% discounts. That's when you make money. And here's my pricing model. To make all this actionable, I built a multiple regression model to predict home prices. This model takes four key variables and tells you what a home should sell for. The model performs well. So R squared of 0.76, meaning it explains 76% of the price variation. The typical prediction error is $39,000, which is pretty good for the real estate. And here are the four predictors. So overall quality, each point adds $32,000, and this is a big one. Then living area, each 100 square feet adds $6,000. So the size matters, but not as much as quality. Garage area, each 100 square feet of garage adds $25,000, and buyers value storage and parking. And lastly, sale age at sale. So each year of age cost you $650 and older homes are discounted. So the key insight here is quality upgrades deliver 5 times more values than size additions. If you are choosing between a building an extra room or upgrading to premium materials, upgrade the materials. You'll get a much better in return. All right, let's make this concrete. Here's what each group should do. So for sellers, list your home in May or June to capture that $15,000 seasonal premium. If you are planning improvements before listing, focus on quality upgrades, which means modern finishes, better materials, updated fixtures. Don't pour money into room additions. And if your home is old, be realistic. Major renovations won't fully overcome age-related discounts, so don't overinvest. Then for buyers, shop in January or February when the competition is low, and you can save $12,000 compared to summer prices. Don't overpay the renovated old homes as the age discount is baked in no matter how nice the finishes look. Prioritize the quality over size and negotiate harder in winter months when sellers are more motivated. Then for investors, buying during market downturns when you can get 20 to 30% discounts is a good choice. Then target quality 8 homes around 1900 square feet, and that's the spot where the model performs the best and demand is strong. Focus on renovation budget on quality upgrades, which deliver 5 times the ROI compared to adding square footage. Then for developers, build quality 8 homes around 1900 square feet. That's where buyer demand is strongest. Use premium materials and finishes rather than maximizing square footage. Avoid building luxury spec homes over $300,000 because they are harder to sell and the model shows higher prediction errors in that range. So time your listings for June and capture peak prices. So these are the actionable recommendations from me. Then moving to slide 9, methodology. You might be wondering, like, how did you actually do this analysis? So I used a four-step approach. First, exploratory data analysis, that is EDA. I looked at distributions, correlations, outliers, and missing data. And this is where I identified that quality and size were the top predictors. Second, hypothesis testing. I ran t-test and ANOVA to confirm that things like central air, recent constructions, and house style significantly affect prices. All these tests came back with p-values less than 0.001, meaning the results are statistically rock solid. Then thirdly, multiple regression modeling. I built a model with four predictors that explains 76% of price variation. I checked all the assumptions and looked for multicollinearity and uh, hetero statistically normality of residuals. The model is valid and reliable. Then fourth, time series analysis. I decomposed the data to final seasonal patterns and trends, and that's how I discovered the $20,000 seasonal swing and the 22% crisis decline. All of this work is documented in my full analysis website, which you can find at the link shown at the end of this presentation. So that's it. And to wrap up, quality is the strongest driver of home value and $32,000 per quality point. Then timing matters and uh, mostly list in summer for a premium, buy in winter to save. Third is age is penalized heavily, where $650 per year. And crisis throws are buying opportunities, which means 20 to 30% discount. My full analysis, including all the code, statistical test, and interactive visualizations, is available at the GitHub link that I've given here. So feel free to explore it and reach out if you have any questions. Thank you so much for your time, and I hope these insights are help you make smarter real estate decisions. Thank you.